In this video, we're going to look at Global Payments, and this is a credit card processing company. And what I do in my videos is I try to figure out the real stock price of a company using prior financial information, also looking at the capital structure. And then at the end of the video, I look at the financial ratios. I'm going to be doing all this with you on the video, so as if you're doing it with me the entire time. So let's get started with the model. This company has a market cap of $49.1 billion. And they're trading at 164.16. And next we're going to pull the free cash flow. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today. Because free cash flow is the cash that's remaining after operating your business. And I'm going to put that into the model. And we could also pull the net income. And this is the profit and loss for the company. And that's on the income statement. And then I'm going to pull the revenue, which is just the sales. And that's also on the income statement. So let's look at the numbers. The numbers look pretty consistent, not too variable. The way to value a company is you need consistent numbers. If they're all over the place, really volatile, it's almost impossible to value. And the margins have been decreasing, it seems. Net profit margin is net income over revenue. So the lower the net profit margin, the less money that they're converting from revenue into net income. So in 2019, only 8% of their revenue was converted to net income. Net income is the bottom of the income statement. It's what the company earns, the profit or loss. Let's look at the capital structure of the company to figure out the discount rate we need to apply to the future cash flows. They pay $304 million in interest on their debt. And let's go to the balance sheet, see how much debt they have. Go to liability section. And they have $500 million of debt due within 12 months. They have $9 billion of long-term debt. That's debt due after 12 months. Since interest payments are tax deductible, let's get their effective tax rate. The income before tax is $517 million. And the income tax is $62 million. So their tax rate is 12%. So the cost of debt is 2.8%. To get the cost of equity, we need the beta, and that says how much the stock moves relative to the entire market. And they have a beta of 1.14, so the stock moves a little more than a market. And let's get some more information from the balance sheet, because we need to look at the ratios later. Let's go find their current assets. These are assets which can be liquidated into cash within 12 months, and it usually includes cash, accounts receivables, and inventory. And they have $4.4 billion of current assets. We also need our current liabilities. These are debts and payables, which are due within 12 months. That's $3.6 billion. And their equity, that's assets minus liabilities, and that's $28 million. And we'll pull their EBIT, earnings before interest and taxes. On the income statement, that's called operating income. So that's how much money the company makes from its regular operational business, but before it pays interest on its debt and taxes. So let's look at the capital structure. So the cost of debt is 2.8%, and they have 26% of debt. And the cost of equity is 11%, and they have 74% of equity. So to get the weighted average cost of capital, it's a blend of the cost of debt and the cost of equity. So the WACC is 9%, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using weighted average cost of capital. And we get a value for the company of $28 billion. We divide that by 299 million shares. And we get a calculated stock price of $94. So according to the model, the stock is worth $94 today, even though it's trading at $164. So it's trading at a 74% premium. It's a sell according to the model. Let's see what Simply Wall Street values the company at. They're saying it's $156. So they're valuing it a lot more than I am. Everyone uses their own models and their own assumptions. Let's look at the historical stock price. It's been pretty much on an incline for many years. It dropped a little bit, it looks like, in March, but it's come almost right back up. So it's sitting around 170. So let's look at the financial ratios, get some more information on the company. They have a really high PE, terrible PE of 106. That's price to stock over earnings per share. That indicates investors are willing to pay $106 for $1 of earnings. I like to see 15 or under for this. Price to sales is 8.3. That's price to stock over sales per share. I like to see under 2.5 for this. They have a good price to book of 1.8. That's price to stock over book value per share. That's mainly because they don't have much debt in a capital structure, so they have a good balance sheet. Current ratio of 1.2, so they can cover their current liabilities. They don't provide much of a return to the equity holders. 2% return on equity. That's income over equity. 2.6 interest coverage ratio, so they can only cover their interest payments 2.5 times. So they don't have the best ratios. So I think my valuation is more in line with the ratios. It seems like Simply Wall Street may be looking more to the future of the company, not so much at what they're currently doing right now. So let me know what you think of the video. Thanks for watching.